comfortable with their asset protection, or they may be willing to take a risk and go for the fences. But at the end of the day, as much as is important about the actual rate of return, because sometimes numbers on a deal are just numbers on a deal. An IRR is based off of assumptions from a sale, which is based on you hitting numbers on your bottom line. So there's a lot baked into that. And what I find, a lot of our investors are doctors, lawyers, local people. We have some Wall Street investors as well. We were just out for a dinner recently, and we have a couple acquisitions coming up on Lucerne. We have $20 million in new acquisitions. We're going to be raising $6 million at the end of September, so we're having some initial discussions, and we haven't figured out exactly how we're going to map out the deal as far as a return profile. And you know, they're like, well, which one should I put more money in? And what I always tell everybody is, you know, you need diversification. So you should be putting money in real estate. He talked about depreciation. That's so important, especially for high wage earners, right? So you want to make sure that, and a good way to sell your investors is say, look, I can't guarantee you that we hit these returns or we go better. We've been fortunate to blow away all of the returns that we've done on our projects, but there may be a deal where we're up, you know, where we don't hit that. So you want to say, listen, there's unique things that can happen in any given market. So you want to try to diversify and say, keep some fresh powder on the side for the next deal. And that may kill you because you want to raise more money from that person. And you tell them, hey, listen, you know what? If you have other friends and family, we're trying to keep the maximum to this level. People are like, oh, I want to give the maximum. And be like, we're trying to diversify and give people an opportunity to partner with us. But I think to just finally get back to the point on the rate and switching businesses here, to the rate that you're going to pay out, it's really about the risk profile in the deal and what the total project level returns look out to be, and then you have to reverse engineer it where you think you can provide a return to the investors and it's worth your while to run that project. You have to see what your return looks like if you hit your projections. So again, there's no absolute rules. I think that the prefs, especially on higher, like larger assets right now, is dropping. You know, we're seeing lower prefs in, you know, sometimes as low as 5 or 4. Sometimes there are deals now that don't have a pref, but again, it's about educating about the risk of the deal. Like, you're doing a multifamily, it's a lot less risky than repositioning a retail strip center, and you should get compensated differently in those deals. But the whole times, you know, depends if it's a value add project. A value add project, you should have a liquidity event, typically within a year, 2, maybe 3 at max, where you reposition the asset, you're able to refi and get your money out, or you sell it. If it's a long-term hold where you're slowly going to push up the numbers, maybe you're looking at a 5 to 7 year window before you refi and get your money out, or sell the asset. But I always encourage you to talk that there's multiple strategies to the investors and set those expectations. Hey, we're planning on holding this. Like, we had a building that we just sold down in Charlotte, sold it for $8.2 million. We were in it for like a little over $5 million. We planned on holding that for 7 to 10 years and having a liquidity event. We had a massive fire and we had to think on our feet and change up our strategy. We put in these dollars and it just didn't make sense for us to refi and hold it, and we cashed out. Our investors made a crazy return. You know, they were in the well, we're still waiting for some insurance proceeds. They may be in the upper 30 to low 40% IRR on that deal. That was way above, it was above our projections, but you have to be dynamic. So, you know, the investors were like, oh, that sucks, the deal's over, we were gonna go in, but you gotta be dynamic. So hold times can vary, but you wanna let your investors know that there could be multiple strategies, and they'll respect that, right? Because you're gonna show them that you're thoughtful about what can happen and that you're dynamic.
David, real quick, you mentioned the value add experience.
Yeah.
Can you talk a little bit for folks that might be thinking about a value add? What goes into the value add to boost NOI? What are some of the
Sure. So there's a lot of different things that can go in. I'll just try to hit some quick bullet points. So a value add could be as simple as just poor management and coming in and you're looking at managing the asset better, just from everything from when you're moving out evictions, when you're doing your turns, getting better economies of scale as far as what you're going to do, maybe purchasing more material up front, so on and so forth, about improving the lighting in the common areas to allow you to push up the rents. Maybe the rents are 12, 15% below market, and you have to decide what kind of capital improvements you're going to put into that. Maybe you find that, if you add granite and a stainless steel kitchen appliances in those units, you can push up, $25, $50, $75. You have to look at what that is and how that affects the bottom line. So if you have 100 units, that becomes a lot of money to the bottom line. So it can be anything from minor improvements to a heavy turn where you're coming in and fully renovating. Like we're buying a project in Philadelphia, and we're going to be coming through and doing a high upgrade to each kitchen. We're going to take them out, put in really nice finishes, upgrade the floors, all the common areas, the lighting, because we see that there's product in the market that's $600 higher than where we stand today. And if we just fill like kind of in between, like we raise it 300, we're going to be really ahead of the curve. So you kind of have to be a little bit thoughtful about where you're going to put the dollars and what you can get for it. And that takes some deep dive and some knowledge and, picking brains of your brokers, of, calling up all the apartments and seeing what they have there, touring those and pretending like you're going to be a tenant, look at the materials and do all that stuff. So, you could do a whole day on that topic, but that's...
Anything to add to that?
How much time do I have?
30 seconds.
I'll use David's trend and stance. So I want to start by saying that before you start looking at the returns, you have to look at the operator, because everything kind of boils down to the type of the operator you're dealing with. If the operator has the experience, has the track record, and knows what they're doing, then no matter what kind of deal you're in, they'll make sure that the deal will succeed. But if you have a great deal but a poor operator, then it's only a matter of days or maybe years for the deal to go down the toilet. So always start by researching the operator, what kind of experience they have, how long they've been in business, how they're conducting their business, what kind of strategy they implement, and just have a conversation and see, as again David was saying, if you were able to establish rapport with that operator, if the strategy they're implementing and your plans and ideas are resonating with what they're doing, if you're aligned with what they're doing. Because no matter what, but again, if their strategy, if their plans and ideas are not resonating with yours, then you're going to have a hard time working with that person for a long time. And when you're investing, whether it's 5 years, 7 or 10, you're investing for a very long time, and your money are illiquid. So keep that in mind. So that's number one. Number two, when it comes to looking at the numbers, and you are talking to a numbers person, as some of you may guess, I always suggest don't look at just a single number. Always look at the whole bouquet, because you may have 15% IRR in two separate deals, but your cash on cash or your annual return is going to be different. The IRR, to get the 15% IRR, you may get a large lump sum at the beginning, or you may get a large lump sum at the end. Depending what else is going on in that kitchen is going to significantly impact, or should significantly impact, your decision. So always look at the whole bouquet. It's very important to look not only at the quantitative factors such as annual return, cash on cash, holding time, loan terms, and so forth, but it also is important to look at the strategy. What are they doing? Is it value add, or is it just pure long-term hold? What kind of value add? What are they doing? Let's say, I'll give you an example. If the operator is buying a B-type asset in an A area, And for those that don't know, area means a highly expensive area. If they buy an expensive area and planning to raise the rents by $200, then that's probably okay. But if we take the very same asset, let's say this is a B asset and we're going into B to B minus area, then $200 rent increase may not fly well. So the strategy may not be the best one for that location. So always keep that in mind. Always review the overall offering memorandum, the full document, to see what kind of strategy is going to be offered, how is the operator planning to implement it, and whether it's feasible and realistic for the location, for the duration, for the area, and given the economic times, as well as the specific geographic location, because no matter what they say, everything is hyper-local. You can take New York versus Trenton versus Philadelphia, and the markets are completely different. So always do a due diligence, full research on the operator, number one, on the market, number two, and the terms of the deal, number three.
Perfect, thank you. I'm going to fire off a couple questions individually and then pass the mic around, kind of, if anyone wants to kind of explore these additionally. But then maybe I'll start with you. And this goes to kind of Alina's point here, is your process similar to Alina's? What do you do due diligence on first? Is it the market, is it the operator, or is it the deal itself? You want to expand on that a little bit?
Yeah, so I agree with Alina. I would, go with the operator first. We want a great operator. In terms of percentages, it's kind of hard to classify. But if I were to put a number, I would say I would give operator kind of 50%. That's how much I would price. Secondly, the market would be worth like 30%, and then finally the asset would be like 20%. So that's my opinion. Definitely the trust in the operator, and how they are able to, what kind of experience and track record they've had in the past deals. Ask them about what their failures have been, or what was a difficult situation. Because recently one of the operators, I didn't invest with them, but they had a huge fire in their apartment complex, and they were still able to meet the pref, and that goes to say a lot.
I think the operator is so important because there's a wider range of investors and syndicators out in the market, and I've seen a lot of them just tank on operations. Those create great opportunities for value add, coming in and buying behind a syndicator that doesn't know how to really operate. So you want to figure that out. You want to spend time asking them, or if you're going to go out and raise capital, you want to spend time really digging into your due diligence or theirs. You want to understand their projections. So if they're showing that the returns are based off of a X, improvement in market rents, how can they prove that to you? Are they going for the fences, or are they the middle of the road? What time frame are they realistically going for? I think I was saying last month or the month before, Jason did an amazing meetup, and they were going through due diligence. I was like, this is probably the coolest meeting I've been to in like a few years. I go to a lot of meetings. So we're digging through the due diligence, and that is where you really understand your level of risk with that person and how comfortable you can get with them. And if you're not as familiar, call up Jason or call me up. Say, hey, can you look at this deal with me? Can you give me your opinion? Can I have your set of eyes? So understanding the projections and understanding how they're going to achieve that. And then the last thing is location. We talk about certain yield returns. People chase yield without knowledge, and the problem is people are going into tertiary markets that are challenged, and those markets, when the market does change and swing, maybe you can now get 7 cap in a tertiary market, which sounds crazy, when the market is weak and maybe into the low to mid-teens on the high end. So you can get destroyed on an investment if that turns. So you really want to understand the market and the risk level that goes with it. So the operator is super key, underwriting and that area.
And Dan, I'll throw another question your way. What's your process for bringing an investor into a deal? And then also, do you have a tracking system or a CRM that you use to kind of get the deals out to certain investors? And third question, do you kind of know in advance what their return criteria or return expectations are when you bring deals to investors?
You're going to have to repeat all those, so I'll get back to you. As far as, yes, again, sales approach, got it. Your database is your data bank. So you keep yourself organized and all the people that you need to contact, that is where the money's made. So again, approaching it like my real estate business, staying in front of people. And it's funny because I initially started email blasting opportunities about people I have pre-existing relationships with and I've talked real estate with. Started around 200 people per blast. And I remember the first deal I was raising, I'm like, oh man, a few of these country club people I have caddied for over the years, it's like, man, any one of those guys could just pick up the whole raise himself. Can't wait. So I sent it out, crickets, and then